Welcome to my series on how to buy a home in the United States. Lesson number 1 taught you, who do you go to? Who should you go to first? A real estate agent, a bank, a mortgage broker, or a mortgage banker? Who is going to help you best? Maybe even you belong to a credit union and you can speak to the credit union. Number 2, how's my credit? One of the things that most people didn't know is that you can get a free annual credit report just by going to annualcreditreport.com. So if you're interested in how you work around your credit, look at lesson number 2. Lesson number 3 talks about your income. How much income actually counts off your paycheck? Is it your gross? Is it your net? What about your overtime? What about bonuses? And lesson number 4, we're here today to talk about your debt. How much debt do you have? One of the things that most people don't realize is if you have less than 10 payments on one of your debts, like a car payment, a student loan, any kind of thing that you have to pay monthly, that's not a credit card, not a revolving debt, something that has actual payments, like a car payment. If you have a car payment and you have less than 10 payments, make sure you pay it down to the 10 payments before you run your credit report for your mortgage loan. Now, if it's a lease, that's a whole different story because less than 10 payments, you're going to go and get a new car and get a new lease, right? So when you're looking at your debt, what kinds of debts actually count? Another thing is student loans. Student loans are sometimes the kiss of death, but it depends on how much the loan is. You know, when somebody says they have a student loan, I'm like, is it in repayment yet? Because if it's not in repayment, we still have to count it against you. So back in the day, they did not count your student loan against you if you were not paying on it yet, if it was deferred. However, what happened is they didn't count the debt. When the debt kicked in and you already had a house payment, a lot of people defaulted on their student loan. So now they do count your student loan debts against you, even if you're not making a payment on it, okay? So remember, if you have less than 10 payments on something like a car, that's a purchase, not a lease, you have student loans, and then you have credit cards. So you have to know how to work around the credit cards. And one way to work around credit cards, now I talked about credit, okay? You need to pay down those credit cards so they're at somewhere around 25 to 30%, because what that's gonna do is go ahead and raise your credit score. So a couple of things have changed and you've got to keep up with what our government's doing and what the rules and regulations are doing. So always work with a loan officer or a real estate agent who's up on all the current changes. Recently, the change was, you used to be able to have a 740. If you had a 740 credit score, you got the best interest rate. And that was awesome. But guess what happened? Look it up and see who changed it because you're going to love it. Not. What happened was it used to be if you had 740 or higher, you got the better interest rate. If you had 739, you were up by a quarter. They raised it all the way up to 780. Who do you know that has a 780 credit score in their middle score? So what you have to look at is you don't look at your high score. You don't look at your low score. You throw the high one out, you throw the low one out, and you have the middle score. Now, that's the middle score of the lowest borrower. So if you have a spouse and their middle score is that 780 and you think you're going to get the better interest rate, but your middle score is 740, they're going to go by your middle score. But one thing might be really cool is if you're getting a conventional loan, not an FHA loan, if you're getting a conventional loan and your husband qualifies without you, you can be off of the loan and you can let him qualify for the loan without you with the better interest rate or the better score. So there's so many little tricks that you want to make sure that you have a loan officer that knows how to work with a buyer, that knows all the different programs that are accessible to you. Now, just because interest rates are high doesn't mean it's time not to buy a house. Come on. So what you really want to get off the fence, and I keep telling people, don't sit on the fence. I bought my first property when interest rates were at 18%. You need to work with somebody that knows how to move you forward and help you get that first home. That's why I'm doing this series on how to buy a home in the US. So remember, if you have any debt, you want to look at your debt and you want to figure out which debt is going to count against you. If you have no debt, great, that's perfect. So we have your income, your debt, we have good credit. And next we're gonna do is I'm actually gonna sit down and show you how the debt ratios work on the different types of loans. Now that's gonna be a lot longer video, and you might wanna stick around and you might wanna get a paper and a pen. That will be lesson number 5, actually calculating out the ratios, FHA versus conventional, and the different types of conventional. Should I get a 5-year loan or a 3-year loan or a 30-year loan? If you're not going to keep the home for at least, I want to say 5 to 7 years, you might not want to get a 30-year loan. If you're going to buy a home and you're going to use it as a stepping stone, you're only going to have it for 3 to 5 years, you're going to sell it, you're going to take the money out of it and buy your next bigger, larger home. Okay, in that case, don't get a 30-year loan. Why are you paying the most expensive loans? You'll get a shorter term loan and get a better interest rate. But right now, those rates are not that high. So you got to know which loans are doing what. There's so many programs out there. So next lesson, we'll talk about the actual ratios on 30-year fixed rate loans. And then we'll talk about the different types of programs. And they may have to be 2 different videos because that's a lot of stuff to learn. And remember, you can always text me. You can always ask me questions because we're here to help you buy a home in the United States. I look forward to helping you. Remember, the next class is going to be actual debt ratios and how you calculate them out. So you should have already ordered your free credit report on annualcreditreport.com. So you should have that in front of you. You should have your pay stubs and W-2s so you can refer to them when we're figuring out debt to income ratios. And you should have all the debt that you know that you have monthly. Now, guess what? Utility bills do not count. Isn't that awesome? So utility bills don't count and your cell phone doesn't count. And your car payment, it won't count if it's not a lease and you have less than 10 months. If you can buy it down before you go ahead and start your purchase process, that would be absolutely awesome. Until next time, when we do lesson number 5 on actually calculating out debt ratios and possibly types of loan programs. I look forward to helping you buy a home in the U.S.